Right, hello everybody. Thanks for being with us in today's Trendsignal Podcast. It's the 17th of April 2023. My name is Adrian Boothby and I'm joined with Jerry Miller, who's going to take us through a bit about what's going on in the current market. So Jerry, hi, how are you?
Yeah, all well. Hi, Adrian.
Good, thank you, Jerry. So look, we were off last week because of Easter, so we've probably got a little bit to catch up on. But again, at the moment, there's a lot going on with inflation. Why don't you just tell us a little bit about what's been happening over the last week or so and how that's impacting the markets, please?
Yeah, well, the focus last week was the US, and there are two elements that came out. First of all, the CPI, that stands for the Consumer Price Index, that came out last Wednesday. And that was a bit of a sort of a weird number, really, especially where the market reacted to it, because the actual headline number was better than expected. And as you can see, if you just click on that CPI 5%, so that was quite a bit, better than the 5.1% and a lot better than the previous month's figure of 6%. So an improvement, you think, okay, and the market went screaming higher. But actually, I looked at it and I thought, well, hang on a second. The core CPIs, I think that the central banks are all worried about, Adrian, and that was actually plus 0.4% as expected, which actually gives you equates to a year-on-year increase of 4.7%, which is a lot hotter than what the Fed are targeting at 2%. And it's highly likely because of that they are going to be raising rates by 0.25% on May the 3rd. So I sort of looked at it. I thought, well, why did the market react? But the weird thing is, by the close of play on Wednesday evening, the market's actually closed lower. So in the end, the numbers bore out the right reaction rather than that weird initial move that one saw at the beginning of that particular. You could see it actually rallied quite a lot on the upside and then closed down towards the lows. So it sort of is in keeping with what we reckon is going on in the US. And I think to sort of underline it, one of the Fed officials, so the Federal Reserve have got their rate setting committee, the FOMC, and they've got a rotating board of people who appear on it. And this chap called Thomas Barkin, he really sort of dispelled any notion that the Fed may keep rates on hold, because there were a few people who investors who thought, when that data was announced, that, oh gosh, that means there's going to be no rate hike. But actually, he just said the data might be moving in the right direction in the absence of inflation at our target, and that's that 2% level, Adrian. It's hard to make the case that we're compellingly headed there. And I think, well, apart from using rather clumsy language, it basically means that they've still got more to do. So
Well, that's it, isn't it? So and so a couple of things. You just very quickly, why are we interested in the core CPI rather than the CPI, and also what does that target of 2% mean, and why is that important?
Okay, so the job of the central bank in the States, that's the Federal Reserve and their rate setting committee, is to maintain price stability. And CPI, or inflation, that is price changes. And if the inflation is too high, like it has been over the last year, the Federal Reserve have to act. They target, like all other central banks, 2% inflation. Why 2%? You have to have some inflation in an economy to allow manufacturers and providers of services to be able to increase their prices. So you give them a little bit of pricing power, but not too much. And we're way above the 2%. In answer to your question about what is the core rate, the core rate excludes those elements that have actually caused the headline inflation to go screaming higher, notably that big spike in oil, Adrian, when it went up to $135 a barrel, and also gas prices. Remember, they've come off something like nearly 88% now here in Europe. So they're significantly lower than where they got to, but they really got so high by a factor of 6 at one stage. So it all looked very painful. Those are the ones if you exclude those from the CPI reading, you get really a core reading, which is like the embedded, hardcore, difficult to shift, stickier inflation. And that's something that the central banks are focusing on, because that, when energy prices subside, when food prices subside, that is the inflation you're left with, and you've got to get rid of it. It's got to come down to 2%. And that's why.
And so, Jerry, and people might be sitting there thinking, okay, well, we seem to be talking about an economics podcast. So why is this important to traders?
Oh gosh, well, as you all know, interest rates that are set by the Federal Reserve, they affect everything. They affect the cost of borrowing for companies listed on the stock market. That will affect all the indices we trade. It affects the dollar. With higher interest rates, the US dollar rallied, and with expectation of no more interest rates and possibly 2 cuts in the US, the dollar has been falling this year. A weaker dollar, what does that mean? Well, it makes a lot of dollar-based commodities a lot cheaper. So it's got a lot of ramifications for the instruments we trade: commodity, US dollar-based commodities, equities, indices, and obviously foreign exchange pairs as well, any of the dollar pairs.
So it's sort of movement stimulating information, isn't it, really?
Yeah, absolutely. And that's why, when we put our podcast notes out, Adrian, we refer to those markets that are quite sensitive to particular bits of information. And obviously inflation data that has a direct impact on the Federal Reserve and the interest rate decisions they're going to make, that is clearly something we want to know about and we want to discuss it.
Okay, that's great. And a couple other headlines then, Jerry, if you want to just go through some of the things over the last week that we really need to be aware of.
Yeah, I mean the sort of PPI data. This is
Yeah.
another bit of inflation data that I mentioned, a couple 2 or 3 minutes ago. Producer price index. That is something that is a future predictor of inflation to be. If you want to look at it, it's a measure of the cost of goods and services going into production. And so if the raw materials that are used in production are increasing, then those finished products, those goods and services, remember, a lot of services have costs going into them when they're in their final sort of guise, as it were. Those products and services will be higher if the PPI, if the input prices are going up. So this PPI data that was released on last Thursday contradicts the CPI data. And of course it can do. It basically means that the cost of those goods going into production is starting to subside. And that bodes well for future inflation, which is likely to carry on falling.
That's great. Thank you, Jerry. That's excellent. Anything else? I mean, certainly some of the, what about the indices? How have they been moving?
Yeah, the indices had a really good week last week, and one of the notable ones was actually our good old FTSE 100, up 130 points. And if you look at the chart, that was a rise of about 1.7%, but it's been relentless, the FTSE 100. I mean, look at
Yeah,
that.
yeah.
And I just think, we're a much maligned economy here in the UK. The OECD, the IMF, even our Office of Budget Responsibility, the OBR, they don't paint us in a particularly good light, and we tend to sort of better. We've done a lot better than a lot of forecasts, and I know we're still the sick man amongst the G7 economies, but I've got a feeling that we're going to beat those more recent upgrades as well. And I just find it strange that we continue to be the butt of everyone's sort of downgrades, as it were. But the irony of irony now is, Adrian, that we were going to have a recession this year. This was predicted in fourth quarter last year. We were going to have a recession lasting up to 6 quarters, and now we're not going to have a recession at all. And the US, which is one of the strongest economies, albeit it's a technical recession, they're likely to have a mild recession in the second half of this year. It's just weird how those things change. But
Absolutely.
our FTSE, for example, the reason why it's done well, Adrian, is banks. Look at what the banks did last Friday. And this was not
Yeah.
actually inspired in the UK. It was actually US banks, JP Morgan Chase, Citigroup, and Wells Fargo all beat consensus, i.e. expectations, and the banks really did light up, and that's really helped the FTSE again. And it's just gone in a straight line.
What's interesting when I look at this chart is that the speed in which the FTSE fell sort of did a bigger move in half the amount of days, it seems. So it's really interesting. That's fairly typical, isn't it? What do they say? Down by the
Elevator back up by the
elevator and up back
stairs.
to the stairs. Yeah, yeah.
Yeah,
And
I
you can
mean,
actually see that. This is a classic example of that. The speed in which the markets go up is typically less than the speed in which they go down. A lot of that's down to fear, panic, getting out of positions as quickly as possible. So, you
correct.
get the fearful driving of selling pressure against the slower building of positions. Yeah, it's interesting. It's a
And
great example.
that slump, Yeah, and that slump that you talk about that is on the chart here, that was caused by the mini banking crisis with SVB
Yeah.
going bust and the Signature Bank and First Custodian. Yeah, that's what caused it.
Okay, great, thank you. Let's have a quick look at what we've got coming up for the next week or so. We don't have interest rates announcements next week. Sorry, this coming week. We don't have non-farm payroll, so it's a little bit lighter, but there is still a few very important items of data, Jerry. Do you want to give us maybe your top 2 or 3 highlights for the week that traders really need to be aware of?
Yeah, I'd say Tuesday, a bit of data coming out of China. Now, China unlocked from its zero COVID policy, its disastrous zero COVID policy, actually, which Beijing had been promoting, but that all changed at the end of last year. So we've got what's called gross domestic product data, and this is the measure of all goods and services produced in the first quarter this year in China. It'd be absolutely fascinating because they posted some really good export data. So I think this Chinese economy is going to post some pretty strong numbers. 3.9% is the consensus that you can see there. But some bank, I think Standard Chartered is forecasting 4.9%. So there's some quite juicy numbers there, and we do expect that number to be quite strong. Interesting to note that Xi Jinping, when he announced the end of the zero COVID policy, he said that they would expect growth to resume and be 5% this year, which for any normal economy, you'd be thinking, oh my God, that's on fire. But actually, in the context of China, it's quite a modest target, really. Nevertheless, global markets will be very sensitive to that data when it comes out, and it will come out when we're fast asleep. So when we wake up, unless you're a night hawk or night owl, we will see the effects of it in our markets when we get to our screens on Tuesday morning.
So it could be that if you're particularly risk averse, and if maybe you're fully leveraged at the moment, you might just want to think about perhaps reducing some of the risk there, because you can react before the data comes out. Probably a little bit better to do that than reacting after the data.
Yeah,
It may not be it may not have that much impact on the movement, but again, that's the sort of thing that you can do for information that's happening whilst we're tucked up in nanites, as it were.
yeah.
Okay, so we've got, and then on Wednesday, UK CPI, so that's obviously going to be quite important. Big numbers at the moment still, aren't they?
Yeah, if you remember this time last month, we got that surprise jump in inflation, and I think it's just bad timing actually for the UK, quite frankly. But I think it will fall again. So last month it actually jumped to 10.4%. Bearing in mind, you've got headline inflation in America at 5%. You've got it falling, tumbling quite a lot in Europe, in the Eurozone. And yet here in the UK, we're beset by higher inflation. And I think it's partly down to Brexit. It's partly down to the dependence on Europe for some fresh food produce, and I think it's just a bad timing on some of these measurements. But I think what we're expecting now for inflation is a fall now to 9.8%. I actually think it might fall a bit further than that, looking at what other major economies have done. But that's one bit. The bit they don't show on this calendar, Adrian, is core inflation. Going back to what we talked about, that's the one that excludes food and energy. That's the one that the Bank of England and the MPC will be more interested in. That's the focus of all central banks. And that's expected to fall to 6% here in the UK, having jumped a little higher last month to 6.2%. So I think inflation's heading in the right direction, but just not as quickly as the Eurozone and the US.
Okay, and then something that gives us a bit of a clue on that as well is going to be this flash manufacturing information that's coming out on Friday. So we'll just finish off with
Yeah.
this one, Joe. Just tell us a bit about.
Yeah, there's a ton of it. That you get the UK, EU, and the US all releasing their flash readings. This is their first reading on the health of the manufacturing and services sector. It's called the PMI data, the Purchasing Managers Index. It's a key reading on the developed world's economies. We're expecting a modest pickup in the manufacturing sectors, but still note that they're below the 50 level, which marks the boundary between contraction and an expansion. The service data is doing much better, although there isn't much improvement expected this month. And that's it, really.
Okay. Good. Jerry, that's great. Thank you very much for that, as always. So we'll be back next week for more from Jerry. But in the meantime, what I want to do now is just move on to having a look at the different markets, what we're trading. So the next segment, just a couple of minutes. What should we be trading at the moment? Let's have a look at those. It's been some really interesting moves over the last few weeks. And what I've been doing is looking at some of the major markets, looking at the sort of near sort of support and resistance areas. We're going to have a look at some of those today. So let me just bring my charts in, and we can also have a look at some of the different markets, some of the trades we've had over the last few days as well. So first of all, let's have a quick look at euro dollar. We're not going to spend too long on each of these. It's not going to be a big full-on analysis fest. But one of the things that we look at for trying to identify where markets might go is support and resistance. Now, it was a couple of weeks ago, it was back sort of around here that we did our last podcast. The expectation was a move up to that sort of 109.58 level. The market actually hit that level there. Found the resistance that we'd expect, but actually then rallied back higher from there. So in terms of next objectives, so really nice, found resistance as you might expect it to be. Now we're looking at 111.24 is the next area. So we continue to push up from here. Expect a little bit of a reaction to the upside at 111.24 for the next area of resistance on the euro against the US dollar. Similarly, again, a lot of these markets going on and hitting those numbers that we've been looking at. The S&P 500 just on Friday, nudging through that major resistance level at 41.60. You see how many times we hit it? 1, 2, 3, 4, 5, 6 times there, struggling to break through and above that level there. Feel like that game whack-a-mole, heads being popped up, it's being whacked straight back down again by sellers. We saw exactly the same thing on Friday, failing to stay above that level. Still a positive day, you understand, but again, we're finding that reaction off that number now, of that major resistance on the broader S&P 500 there. So really important level there. If we can get a convincing close above this dotted line at 41.60, 43.01 is the next level from there. So yeah, keep an eye out for that, please, everybody. Definitely interesting at these levels. Gold. We can see here that it again, similarly, if I just compress back the chart again, we had to go a little way back for the last resistance level up to 2025. Again, we hit that on that week that we're off. That's the level we were talking about a couple of weeks ago. We've hit that level now. And again, we just had a little wave higher. Again, dollar price, so it's moved in a similar kind of way to the euro, backing off a little bit from there. So in terms of gold, the next level is 2052, and the next level to the downside is these two pivot points, 1937. So be aware of that level. We found some support off it there back on the 21st and 22nd of March. Have a look out, see if we can come down to prices down there. It's an interesting area of potential support for gold. The last one I will quickly look at for some of these levels is the Dow. You might think, why are we doing that? We looked at the S&Ps already. There's quite a lot of congestion up at those levels. When you look at these dotted lines moving to the right, those red lines there, these are from previous resistance levels, previous highs. You can see the way the market's hitting that level now. You know, the cluster of these pivots in here. What that's likely to mean is that you see how smooth the movement was there. So as you want from here, you sort of break the congestion that takes place here. So, you know, what happens is the market finds those turning points, conflict between buyers and sellers will increase. So volatility will increase at that point. Once you get the winning side, i.e. the buyers or the losers, in this case, the buyers, it can move in relatively free moving way until conflict starts to take place again. As you move to this area of lots of pivot points here, we're likely to see some conflict there. What does that mean? It means something could well happen like this. That's what I would expect. You know, that more kind of, you know, day up, day down, day up, day out, day down, until the winner you know, is emerged. You know, is it going to be the buyers that'll drive prices high and break it up above, up to, you know, above 34,500, or will the sellers drive prices down? What I would suggest is, or expect, is a little bit of chop over the next week or two until we can find that winning direction. Okay, let's have a quick look at results as well over the last couple of weeks in terms of the Trendsignal strategies. So the Trendsignal D1 sniper strategy, so an end of day trading strategy, that's up 7.6% so far in April. That's up 543 pips. Notable winners there being on the Nikkei, I had a really great buy trade there from the 12th of April. That was a 2.35% winner on our accounts. There's some really good trading opportunity moving on nicely from that buy, actually hitting target in that first day. So good, really nice reward to risk on that opportunity. So that's on the JPN 225, really nice there. Clear. That's what the snipers are all about, is about kind of breaking down a lot of the complexity that there can be with trading to something that's clear, something that's visual. We see those snipers, and that makes it a lot clearer whether we have an opportunity or not. Also, then we look at Australian dollar against the Japanese yen. Some really interesting moves. Again, a lot of these trades, we're only in them for a day or two. This one, a winner of about 1.5% or so. I like these pink snipers. The color of the inside, it means the type of trading opportunity that's taking place. So these gray ones are very much sort of trend continuations. These pink ones are more about trend reversals. So if I put my cursor over any of these bars, you can see the weekly and the monthly trend at that point. It's down. Weekly is down. Monthly is down. That's suggesting that the bias of this market is like this. However, at some point, that trend has got to change direction. So what's the early sign of that? Well, it's very difficult to get in the actual low, because that's really just a guess as to whether that's the actual low or not, unless you've got support you're bouncing off and so on. That's why often, the first move up is not a sniper, right? Then you have another wave down, which we had here. That ended up being a small profit. It's reasonable enough trade. But what's interesting here is the market then put in a higher low. Okay, so there's the low, there's the higher low. The market's starting to break its way back. In order for it to start an uptrend, it needs to start having higher lows, right? It's got to start ratcheting its way up like this. This is the first sign of that starting to take place. So yes, we are against the longer term trends, but the chart patterns are starting to build back the other way. The market's turning back into the right sort of position, gave us a buying opportunity. The system is doing all of that hard work for us, and that's produced a really nice, clear, winning trade that, again, we're out within 24 hours. So a lovely opportunity. D1 Accelerator, that's having a great month as well, actually. That's up 13.2%. So why are we not talking about that? That's nearly double what the D1 Sniper's up. This is part of our phase 2 strategy. So when you start to use our system, you start on the D1 Sniper, and then it goes a little bit quicker. End of day trading quick, usually as well, absolutely, but usually in and out of trades within a day or two. And that's up 13.2% on the month of April, and that's over 50% now for the year to date. So really good markets at the moment. So this is all about swing trading, or very short-term swing trading that's picking up some fantastic results for our members there. So this actually then brings me into what is the problem. This is just a little feature where we just look at one sort of thing that is a problem for certain traders and see if we can get that done in sort of 2 or 3 minutes maximum. So what am I looking at here this time? Well, for me, it's about which markets to trade. So there's 3 sort of types of trading that I would typically say. You've got position trading, swing trading, day trading. Position trading is generally not so interested in the short-term pullbacks and things. It's about a position for probably a couple of months. So you're sort of like short-term investing, one would say. Position trading tends to be more about stocks. You're holding positions for a little while, maybe commodities as well on that basis. So making sure you're on the right markets for the right style of trading that you want to do. Okay, so swing trading, that's when you're looking at markets rotating for a week or two, maybe a couple of days or so, but otherwise you're looking for more like 4-hour charts, daily charts to be in positions like that. Now, the shorter the time scale you go, the more sensitive you are to dealing costs, and you need to be aware of that. What this does is that when you're trading over a duration of a day to maybe 2 weeks, you want to be thinking about, yes, you can still look at stocks, but also there's some other markets you can really get into as well. Foreign exchange, stock market indices, commodities as well. And what you're looking for is the more liquid ones. You're looking at, you can trade currencies, for example, look at a big currency against another big currency. So that's where the dealing costs are lower. The spreads, the costs associated with them, you want them as low as realistically possible to give you, so that the more active you are, you're not just being hammered on costs there. So you're looking at the pound against a euro, against US dollar, a yen, a Swiss franc, a Canadian dollar, a New Zealand dollar, an Australian dollar. You trade across of those currencies, and then you're going to be in a really good place, particularly with some of the bigger indices, the FTSE, the Dow, the DAX, and so on. Gold, oil, these are great markets for swing trading. The more exotic you get with your markets, the more costs will become a factor, which then starts to eat into your trading and actually becomes really hard, much harder to make a profit. So what I would say to you is look at certain things in a way that makes it easier to make a profit. Don't just trade all sorts. Look at things and question why you should be trading that. Does it fit with the type of profile of strategy you're wanting to do? And if it does, then away you go. And then finally, day trading. People day trade all sorts of markets. For me, in my experience, the best markets to day trade are stock market indices. And why is that? Because the volatility, the speed in which these markets move is probably at its highest compared to the dealing costs that we are charged. So the dealing cost being the spread, the difference between the buy and the sell price, that's fixed, right? So what you want is good movement to be happening between the days. So you don't really want to be day trading a market that might have a daily range of 30 or 40 points. It's not really much opportunity there, particularly if your costs might be 2. You're not really going to get much movement. A winner might be 4 or 5 points. And in which case, if a winner's 4 or 5 points and you're paying 2 in costs, that's a very expensive proportion of your potential gain. It makes it the costs a high proportion. Look at your costs relative to the daily movement. You might look at the Dow or the Nikkei, or the Nasdaq, I should say, and the S&Ps. They might be moving 200, 300, 400, 500 points in a day, in which case a spread of 1 or 2 or 3, it's a very low proportion, which means when you're looking for 30 or 50 point moves, 100 point moves, your costs are very low relative to that movement, which makes them excellent for day trading as well. Okay, so stock market indices tends to be a really good way to go for traders too. And that's basically it for this week's podcast. Hope you found it really enjoyable. So for myself and Jerry, we wish you every success with this week's trading. And until next time, bye-bye for now.